Welcome to Agency Bytes, a podcast for agency owners, hosted by agency veteran and coach Steve Guberman. Agency Bytes is a podcast focused on delivering actionable agency information from agency experts in about 25 minutes. Why 25 minutes? Because who has the attention span for much more these days? And you can squeeze in a listen between meetings with time for a bathroom break or coffee refill before your next meeting.
Welcome to Agency Bytes, a podcast dedicated to helping creative entrepreneurs thrive. I'm Steve Guberman from Agency Outsight, where I coach agency owners to build the business of their dreams. Today, I'm excited to be joined by Clara, Stedman, and Ben Engvall, founding partners at Palmer Advisors. They specialize in guiding founders of service businesses through the successful M&A transactions. Thank you guys for joining me today.
Thanks, Steve. Happy to be here.
Yeah, I'm excited to talk about the current state, future state of M&A in the agency space. I think it's evolved a lot since I don't remember the last kind of M&A gal that I had on here, but it's probably been about a year. So you guys are kind of a fairly new shop. Talk about what your background is and how you came together to form Palmer.
Yeah, happy to dive in there. Thanks again for having us, Steve. So my name is Clara. I'm the CEO here at Palmer. Like you said, we're an M&A firm that focuses specifically in marketing, media, technology. So think any service-based business with little to no tangible assets, really in the lower to middle market. So think businesses that are too big for a local business broker, too small for investment banks, traditionally within the 1 to 10 million in EBITDA threshold. And we're coming up on a year anniversary of Palmer Advisors. Year goes by really fast. Thank you. Ben, myself, and we have a third partner, Alex. We were actually all running our respective departments over at another M&A firm with really no oversight and wanted to be equity holders in our own M&A firm, but really wanted to be entrepreneurs ourselves. It's hard not to be inspired when you talk to business owners and entrepreneurs every day. So after a successful track record, not only as individuals, but really as a group, we felt like it was the right time to split off and start our own thing. But Ben, fill in where needed.
Yeah, no, that was great. And I'm Ben here. I'm the head of M&A. Like Clara said, we're really a boutique M&A firm that kind of focuses working kind of founder to founder direct. So, any firm that we take on to take to market works directly with me, Clara, and Alex. And we go out with a more strategic angle to really, find folks a transaction that they want more than just a transaction that exists or a transaction that they can take. And so, our approach is a little bit different than our other kind of, M&A advisories in the market. And hopefully, our goal is really to provide better outcomes for founders, both financially, but really from a cultural standpoint too. I think, as so much in the agency space in particular, people are really everything. And so obviously the dollars and cents have to make good sense, but there has to be a strong cultural fit too. And so that's really kind of what our focus is.
Nice. So how has, a year in, are you like, man, what the heck did we do? Or are you guys like, throw some fuel on this baby, let's kick it up a notch? Like, how's the first year been?
The first year has been amazing. We definitely, you leave a consistent job and you're like, everyone's around you telling you, what are you doing? Why are you doing it right now? But I think there's no better time than the present. We're young entrepreneurs, we're hungry, and I think we're excited to continue that growth in year two.
Yeah, and I think, we did all kinds of, when you start a business, you do all these financial projections and you start to budget and you do all these things that you've kind of never done before with no real, idea of what they're going to look like or what you're doing really. But we're about, 2 years ahead of where we thought we'd be, at year one. So things are going really well. I think the market reception has been great. We've been fortunate, I think, out the gate to work with some great founders. Some of the best thing about our job is that we do get to work with founders that in many cases, especially when we started, have larger businesses than us. And so that was kind of a great learning experience as we kind of, eclipsed seven figures and kind of moved into a more significant enterprise ourselves. And so I'm very grateful that our industry has given us that crossover, but things are going really well. I think the market in particular has been, booming over the last 18 months. So hopefully we see more of that continue in 2025.
That's really awesome to hear that you've eclipsed what those initial kind of pie in the sky, pulled out of God knows where projections are, because that's all they are. It's kind of, I'm going to launch a business in year one. I hope to hit these numbers, but who the heck knows what's going to happen? And, after you get a couple of years of historical data behind you, then you can make some more calculated projections of 25%, 30% top line growth, EBITDA growth, etc. But that first year is just like, who the heck knows? Can the
Right.
Rolodex really, work for us? The relationships. So that's really awesome news. Without how do I ask this? I'm sure you can't disclose the kind of deals that you've put together and helped execute. But can you talk about kind of the DNA of the agencies that you've helped structure deals for, and kind of what's fallen into place over the past year?
Absolutely. I think, and Clara can talk about this too, but it's really, the range is significant. I think of the exits we've kind of helped, manufacture thus far, I think a large majority of them have been founders that are staying on. And that's, they've built a business to a certain scale. There's either a limiting growth factor or they want to grow quicker. And so they either, join a larger agency, a private equity backed agency, or a holdco model, really to either add services or add, larger client Rolodex that they can then provide their services to kind of see that growth, hopefully double or triple and what had previously taken them, 3, 4, 5 years to do. But we have seen some founder exits as well. The big difference there is really what folks are looking for in deal structure. And I think, over the last 3 years, deal structures changed significantly. I think, they publish reports on this frequently, and happy to discuss that a bit more. But, I think those are the two main, kind of exit timelines we see, is either folks that want out kind of fairly immediately, or folks that are kind of looking to stay on, indefinitely. And so there certainly are folks that are probably somewhere in between, but we see those a little less frequently, I think.
Yeah, I saw just recently Chip from Saga put out a statement where, some sort of a study that talked a lot about the change in structures that he's seen recently, and how more than a third of people are kind of staying on after. I can't, that was my experience, but I can't speak to it. Was that a trend? Is that a shift in the trend? What are you seeing? You're talking about the deal structures are changing. What else are you seeing there?
Yeah, I mean, I would say, short of, and I don't, want to be ageist here, but, short of 65, 7-year-old, folks that are looking really to retire, when folks are making acquisitions in the agency space, there's a lot of times where they want to keep, that talent in-house. They want to keep them, on in a position that maybe they're more comfortable in. Many times it's folks that are scaled to, 3, 4 million in revenue, are sick of HR. They are sick of finance. They're not really as much involved in the day-to-day as they were, when they were 1 and 2 million. They want to have a bit more leadership over, a leadership team, and they want to go do sales. They want to go do
back to what they love about the agency space.
Exactly. Yeah. It gives them kind of an out to do that. And so we're seeing, a ton of folks stay on for those reasons. Oftentimes, it sounds like selling your business when, while the process is a ton of work, it can ultimately be an outcome where, they're a smaller ownership percentage, but there's kind of, more weight on multiple shoulders, and they're able to kind of get a little bit time back with their family where, when you're running a $2 million agency by yourself, you're kind of,
every so many hours in the day.
Saturday too, you're stuck there.
Yeah, that was my experience. I mean, I was burnt out, and I was like, all right, I'm ready to be an employee. Give me a paycheck, give me benefits, and my job kind of stops at 5 or 6 o'clock. I don't need to take it home with me because my name's not on the door. So that was certainly my experience. What are you seeing as far as agencies that come to you and like, I'm ready, I want to exit, either, to your point, Ben, I'm on that, final chapter and I'm ready to just go play golf, or I want to go along with the deal, but they think they're ready. But what are the red flags that really says, hey guys, you're not ready? These are the things you need to work on. Come back in a year or two or whatever.
I'm happy to jump in there. I think something that makes Palmer a bit special in the space is that we are brutally honest. If you are not ready to go to market, I will tell you, because it's our reputation on the line. And at the end of the day, I want to get transactions done and across the finish line and give a great opportunity and exit for a founder. So it's two things that come to mind when we always talk about timing, and then Ben, feel free to jump in where needed. But when you think about timing, no one has a crystal ball to say like, this is the perfect day to go to market, right? But there's two things that founders really need to take into consideration. So one, going to market before you hit your peak. I think that's a common misconception to say, I had the best year yet, let's take it to market, and you kind of take your eye off the ball, where it's absolutely integral to continue to kind of scale the business when you are on market. Buyers want to invest in a business that is continuing to grow. They will ask for updated financials until the closing of the transaction. So that's really important. And then second, and that kind of goes back to transition periods post-transaction, is that you want to go to market when you still have some gas left in the tank. As nice as it would be to exit after 5 days and go sip tequila sunrises on the beach, a lot of times buyers don't want that, right? If you're still involved in the day-to-day operations of the business, you want to go to market when you're not dying to get out right away, because that transition period can really depend on, again, how actively involved you are and who the buyer is.
So let me just jump in with a quick follow-up question, and then you can jump back, Ben. So the first thing you mentioned of you had a killer year, you're at the peak of your charts, don't look to exit then, continue to grow it. And what are you seeing as far as, how would you advise as far as like the multiplier, which is kind of the baseline of what people are looking to use as their valuation, that first year of a peak year versus continuing it for 2 or 3 more years? I mean, does it increase that drastically?
It does. And, there's been so much talk, I think, recently about multiples on adjusted EBITDA. The part that doesn't get enough talk is probably how you actually nail what adjusted EBITDA is. And I think buyers in the market will talk about this probably a ton. But, when they get a SIM from an investment bank or from a broker, how frequently that adjusted EBITDA is inflated. And then in turn, how much, that broker or that investment banker is telling their seller the business is worth, and they're going to hit the market and just truly not going to get that value because, the number that we're putting a multiple on, is not the correct number. And so that's probably, a topic for another day. But I certainly think, higher growth businesses get higher multiples. The peak of multiples in marketing services was in 2022, late 2021, early 2022. It hasn't recovered. And I don't know that it ever will, really. I mean, that was a time in, acquisitions when interest rates were zero. We were paying, 50x multiples on revenue for some of these cybersecurity businesses, which I think we've now seen from that IPO boom that's really kind of collapsed over the last 3 years, that, maybe those weren't the best investments. And so, multiples have kind of, I think, stabilized a bit, as interest rates have increased, and we've kind of seen some of that, extreme leverage, not play out so well in the markets. And so I'd say, we've talked about this probably for the last 2 years, but, businesses under $1 million in adjusted EBITDA are doing somewhere between 2 and 4x on adjusted EBITDA. Between 1 and probably 3 million in adjusted EBITDA, we're seeing somewhere between 4 and 6. Between 3 and 5, it's somewhere between 5 and 7. And then once you get over 5 million in adjusted EBITDA, the multiples can kind of really vary. There's businesses that get a 12 or a 14x, and there's businesses that get a 7. And that really, really depends, I think, on kind of how your business looks. And at scale, that becomes more and more important, specifically as, we're talking about 100-person agencies and things like that, where the fixes aren't quite as easy. And so, if margins are too large in one way or the other too small or too large, that fixes can't be done kind of overnight like it will with a 1 million EBITDA business, those sort of things. And so that's where the variance comes in.
Love that. That's a good breakdown. And then the other part that, Clara, you said is about kind of getting the owner out of the day-to-day and how that affects what the deal could look like, what the post-acquisition looks like. Talk through more of that, because so many owners that I see and talk to and interact with at conferences and on Zoom calls and people I work with, that's the final linchpin of owner-led sales, owner-led everything, owner-led hands in, etc. Like, talk through some of those red flags and challenges that buyers might be weary of.
Yeah, I think in the lower to middle market, it's very, very difficult to have an owner not be involved in any way, shape, or form. It's not an easy task. So I think when someone comes to us and says, I do everything, including handling client relationships and the sales, that's where we really have to break it down. I think I always recommend to potential founders that we work with is that you should have someone on your team that's really handling the client relationships, because when you think about it from a buyer's perspective, they're acquiring the agency, and the contracts, the clients, of course, the people are really what they are purchasing. So if they have to hand off a client relationship from a founder to another person, that's where it becomes a little bit more tricky. So we always recommend to have founders have someone in a senior leadership team, but maybe it's not a full stack senior leadership team. Maybe it's a key employee number 2 and number 3 that is really handling the client relationships. When it comes to sales, I would say it's hard, because when you're an owner of a business, there's no one that's going to be a better salesperson than the founder of said business. So that's really common, where a lot of founders are still actively involved in the sales process. But that's just kind of chatting with the buyer and saying, do you have anybody that already does sales? What's the founder already doing? Is it through inbound sales strategies like SEO, PPC for their own agency? Do they have outbound sales strategies in place? Is there someone that you can really shape up to work on sales with you? But all in all, really kind of nailing who is handling the client relationships beyond the founder is definitely step one.
Yeah, you got to, and I think we don't know everything, right? We don't even own an agency. And so I would hate to tell an agency, like, I can do it. I certainly can't tell you how to do it. That's hard. It's easy to have ideas. It's much harder to implement them. But I would say, get delivery of your service and get, account management off of your plate. Those are the two biggest things. The sales portion of it, if you're not the best salesman in your organization, then you probably wouldn't have led it to where it is. And so that's common. But if you can get those two things off your plate, you're attractive on the market.
Yeah, that's really valuable. Now, the other thing that I'm kind of doubling down on this year, maybe tripling down on this year, is niching. And I'm curious what you're seeing as far as attraction in the marketplace, attraction from potential buyers looking for role, like niching and owning verticals. Talk about the value of that from a buyer's lens.
Yeah, I mean, there's definitely some common trends. I think more so trends within industry niches than service niches, because at the end of the day, every buyer has a different niche that they're looking for, right? Someone might be looking to add on creative services and they might value that much more favorably than someone that already has performance-based services and they don't need that. So service niche, it really kind of depends on the buyer. But in terms of industries, Ben, you want to chat a little bit more about that?
Incredibly important. And Clara talks about this too, but it's very hard for folks to figure out how you fit into their existing business or their ecosystem if you do everything for everyone. And so, the more you can niche down, I think specifically in an industry, more so than a service, has really been helpful. Obviously, it's nice to have clear-cut services. We provide just this and we price it that way and we can kind of demand on the market because we're known for that. And that's very helpful, but industry really is the one that makes a difference on the M&A market. Folks that are targeting roll-ups or private equity backed are targeting industries. That's kind of how they're looking to build these things. And they're looking to kind of build about, a suite of services that are targeting a specific industry, as opposed to, building out one service that targets 10 industries. And so I would, if I was an agency seller thinking about, how I'm going to market, I would really try to make a stronghold in a few industries. And I think the industries in particular, if you're interested in what those are, that are the sexiest on the market right now would be senior living, healthcare, and then
senior living is super sexy right now, is what you're saying, huh?
Yeah, can you believe it? It's industries that they don't have any interest. I would say finance as well. Industries where they have large budgets, but they're not interested in taking those services in-house. No large, senior living conglomerate is really thinking about hiring a marketing team. They've got kind of other things to figure out on the health and kind of healthcare side. So any industry where there's, big businesses with, large wallets that don't want to take those services in-house because it's just something they want to, they want to cut a check and have someone else take care of it, sort of thing. That's what's sexy right now. Even though, really isn't that fun, I don't think, to talk about senior living.
But they also have massive runways. I mean, look at what the senior housing and senior care runway looks like as far as population. So, boomers are moving into it. Next generation is going to be, and so generationally, look at just the runway. Healthcare, massive. So the ones with runway.
Industries aren't going away. And I think the more emphasis on having a specific industry has really come from a lot of agencies saying, my clients are looking for an AOR versus hiring many different agencies to do different service lines. So we've seen that kind of shift as well.
Yeah. All right. So I don't want to assume that everybody who listens to this is as hip to the M&A lingo as you guys are. I'm probably not even on the same page as you guys. So you mentioned a few things that I want you to just kind of break down into English terms. So the most common one is EBITDA.
Yep.
How do you explain that to, let's say, a solopreneur or somebody who's 300, 500K in rev?
Yeah, the easiest way to explain it, it's your net profit and then adding back any expenses that will be non-recurring for a future buyer post-transaction or non-essential to the daily operations of the business. So those could be things like personal expenses running through the business. Maybe you have a car or a phone or a laptop. Maybe it's one-time expenses that you redid your website one year and that cost you $100,000. You're hopefully not redoing your website year over year. So think about it. What is the profitability of your business from a buyer's perspective on an ongoing basis?
And even, we call it the true profitability of your business. If you really wanted to kind of you're not putting your daughter's bat mitzvah through the business. We're not, buying that Jaguar that we needed to drive to our, client meetings that are all on Zoom nowadays. It's the true profitability. And so we're applying a multiple to the true profitability of your business on a go-forward basis.
Love it. And then the different types of acquisitions, owner stays on, a roll up. What are these different? There's probably 3 or 4 that we've mentioned. What are the different types and what do they mean to a potential seller?
Yeah. I mean, I think the most important thing about the acquisition process, it's probably not talked about enough, is that, when you sell your business, you don't have to sell 100% of your equity. And so, I would say there's kind of 4 main deal terms that exist in the space. And that would be cash at close. That's what you receive cash directly for a portion of your equity. There would be seller's financing. That's where, you receive payments over time for a portion of your equity. And you're essentially, playing the role as the bank, as the seller. There's an equity role where you would take your equity in your current business and trade it for equity in a larger ecosystem based on kind of what their valuation and your valuation are combined. And then the final is an earnout. And that's where, you would have some sort of a, whether it's a top line or an EBITDA target over the next, 1, 2, 3 years. And you'd receive kind of payments based upon how your business performs. And those are kind of performance-based outcomes. But more often than not, like you said, for folks that stay on with the business, they do roll equity. And so they maintain equity ownership in a new business. And so when you're going, to market saying I'm, going through the acquisition process, it doesn't have to mean that I'm selling 100% of my business. I could be taking on a partner and selling 70. I could be taking on a partner and selling 60. Or I could be, selling 100% of my equity and trading it for equity in a larger ecosystem. And so I think there really is kind of, various shapes and sizes that things can come in as far as the acquisition process goes.
And I think they also can be, again, my experience, and I've seen this with a number of my clients, they can be very creative. They're not a very just that like black and white. It can be any range of those 4 terms. Yeah.
Mm-hmm.
All right. So break out your... Oh, go ahead, Clara.
I was just going to say, I love that you're also asking us to break it down. I think that's important. Sometimes you get so used to the jargon. Ben has a traditional finance background. I actually don't. I know we kind of skipped over that earlier, but I come from a corporate retail and corporate fitness background where I think the way that we really relate to agency founders is that you're not supposed to know everything about finance and M&A, and it's really our job to be able to break it down into terms that they really understand and they feel comfortable about it. So I appreciate you bringing that up.
Yeah, their expertise is hopefully in running and building the culture, the service, the delivery, the machine that grows the business. And so they shouldn't need to know what are buyers looking for, how do I structure a deal? And that's where you guys come in. So stay in their lane. Come on, guys.
Yeah, yeah, exactly.
Break out your crystal ball, if you will, or what do you see or what do you think you might see in the second half of 2025 from either the vantage point of an acquiring agency or the positioning of an agency that's looking to be acquired?
Well, it's been, I think,
nobody wants to break out a crystal ball because that's scary as heck.
It's been an interesting, I think, start to the year for everyone. Obviously, with the current administration, there's been a lot of things, no matter where you sit in the aisle, there's certainly been some uncertainty and things have kind of changed day to day. And so there's a lot, I think, that folks are kind of digesting as far as kind of what we expect to happen in the second half of the year. I will say, there was a big kind of what I would call an AI scare, it felt like, in the middle of 2024 that I think is kind of gone. I think we've realized, marketing is becoming more and more and more important. It's the driving factor, I think, for almost every business that exists in the world. And it has been, I think we're kind of over that shock. And so I think, over the next 6 months and the rest of kind of, I guess, 9 months for 2025, we're going to see, hopefully, interest rates maybe come down one time or two. But folks can kind of continue on that path of, with AI and kind of technology improving, this is only going to make marketing kind of more important. And so I would expect the M&A activity will kind of improve from 2024 and 2025. Obviously, we hope for that.
Yeah. And people really understanding that the people are what is important in a transaction like this. Technology and AI can only take over so much. That's where we're seeing a lot of big spikes in creative-based work, because that's where you actually need the minds to create the service for your specific clients.
Yeah, the tools are great, but you need someone to use the tool. You can give me all the hammers and nails in the world, and I'll never build you a house. So we're still going to need people to kind of make those things work.
So, but that brings up a great point in that one of the key factors that an agency wants to shift towards is some sort of IP, something that they've built, they own, they're able to monetize. And now I'm seeing more and more shops build out their own GPTs, their own AI products, their own solutions to fill in the blank based on AI powered engines. And so they need fewer people to do what they were doing on 10 people 5 years ago. Now they're able to do it on 3, 4, 5 people because of these tools. And so does that IP that they're building based on these large learning models add value to their overall multiplier or potential acquisition?
I think it really depends if it's revenue generating or not, because if it's not and it's just helping the internal processes of the agency, that's an added kind of intangible factor of an agency, because when you value a business like this, you're looking at the financials, but you're also looking at all of the qualitative factors. So that's really kind of something that levels up the qualitative factors of an agency in general. But if it's not actually revenue generating, that's you don't see really a big jump in multiple.
What you do see is an increase in margin. And I think this is going to become more and more the conversation. I don't know how much it's been talked about. Maybe I'm late to the conversation here, but over the next 6, 12, 18 months, margins are going to become more and more important. I think there was kind of an industry standard that felt like kind of the 50, 25, 25 rule where, 50% of your revenue was going towards salaries, 25 was going towards kind of general OpEx, and then the other 25 was supposed to be your net. I think that number is going to increase with kind of AI and tech. They're going to want to see margins that are closer to 40%, all said and done. Whereas 25 used to be great. I don't think that's happening in the next 3 months or 6 months.
No.
But I think that's where we're heading over the next 12, 24, 36. Folks are going to want to see more margin expansion.
All right. So then, at the risk of going down a way deep rabbit hole, does that mean now my margins are inflated because I'm using machines to do the work, and post acquisition, the buyer, the acquiring agency isn't going to be able to replicate those processes? Maybe they are. Like, is that inflating numbers very transparently, but still inflating them?
It depends on, I think, how scalable. That's why being a buyer is tough. I mean, how scalable are those systems? Are they better than what we're doing in-house? Diligence. I think a lot of the diligence process that I've seen that's been frustrating is there's so much. Some of these small businesses don't have super sophisticated accounting processes, and we're spending so much time on revenue recognition and making sure every dollar hit every account here and there, and that's obviously very important. But where you win an acquisition when you buy a company is acquiring better processes or acquiring better people. And so I would spend, if I was out there buying in the market, I would spend more time trying to find companies that do something better than I do it, more than trying to nail down their adjusted EBITDA every penny. Because when you're buying a company, you want 1 + 1 = 5 or 10. It's going to come from a process being much better or scalable than what you currently have in house. It's not going to come from there being an additional 25 grand of synergy we found from mashing accounting software. So I don't think it inflates at all. I think for good buyers, it makes your business more attractive if you have that. And if you don't have it, then I think that's fine too, but you may not get as much lift.
Love that. Super valid. All right. I don't want to eat up our listeners' ear time, so I'm going to wrap things up with a couple of random rapid fire questions. So, and you can both answer them or flip them back and forth, whatever. So the first one is, if your business had a theme song, what might it be?
Oh, that's a good question. I'm trying to think.
It's probably it has to be a female power ballad. I feel like the 2024 was the year of the female power ballads. I've been a big Chapel Roan guy recently.
Yeah.
So I don't know. Yeah.
No, we love Chapel over here. I'm down with the female ballad.
All right. Sick. I like it. If you could live in any time period, what would it be? Or what would it have been?
Right now.
All right.
Yeah, I'm going with now. I feel like we have so many good things going for us. It's only going to go up from here.
Love it. Very cool. Being in the moment. What's an invaluable business book that you can't recommend enough?
I feel like I've read the old. Go ahead, Clara. You go first.
No. I was going to say you definitely have one. You were just telling me about one.
I mean, I feel like everybody has read. There's like the top 50, whatever the habits one that everyone reads. There's a bunch of those that have been really good lately. And this is going to sound insane. I've been following more Twitter threads from the authors that actually write these business books and kind of watching their conversations back and forth. I feel like I could read more often than I probably do. But as kind of discourse has become so instant, I found more, I find it more valuable for me to listen to the smartest people talk back and forth together, live. But that's my take.
So in a podcast or
give me a book. What's your book right now?
I'm trying to think. I definitely need to be more on my reading. That's not been something I've been able to do since starting a business right away. So that's definitely on my to-do list.
Who's got time to read? I hear you. Yeah.
Well, we read Atomic Habits, and I like that one. That was a good one. That's one to throw out there.
Yeah.
Atomic Habits is huge. That just popped back up for me recently. I put that back in my Audible. I'm more of an Audible than a paper book, but got it. There's always a book on my bedside table. Actually, recently I've been reading Marcus Aurelius, Meditations. A friend sent this to me, and so that's been kind of on the side, and I pick it up and I'll just flip through it a couple pages here and there. But I'm not a cover-to-cover book reading kind of guy. It's very rare.
It's hard to read and walk the dog at the same time. So you need some audiobooks or podcasts.
Yeah. Well, I'm super pumped you guys got to spend some time kind of demystify some of the M&A lingo, talk about what's hot and what's going on for agencies on both sides of the equation. I'm super pumped for you guys crushing your first year and cannot wait to see what you do in years 2 and beyond. Thank you so much for joining me and burning this episode of Agency Bytes.
Thank you so much. It's been a pleasure.
Thanks again for tuning in to Agency Bytes. If you know someone with expert knowledge on a topic that agency owners would love to hear about, go to agencyoutsight.com/podcast-guest and nominate them.